Okay, I think that we'll get started. It's slowed down and participants joining into this Zoom webinar. Okay, thank you for the comment and Q&A that everything seems good. That's good to know as we get started. So I'm kicking off the Tuesday talks of the firm for Solomon Steiner Peck. I'm Laurie Steiner. I'm a certified elder law attorney, and I'll be talking about income tax consequences with regard to Social Security, Medicare benefits, and long-term care insurance. Just some things that people don't often understand or know when income gets too high, or how it works with Medicare. Can your premiums be affected by your income? Those kinds of things. So we're going to talk for about a half an hour on this. After our webinar, you will be receiving a copy of the PowerPoint slides and the outline and an evaluation sheet so that you can let us know how everything went, if you could hear everything. Somebody can't see my face. Apparently it's not meant to be that way. When I'm sharing my slides, it kind of takes over the screen. So at the very end, I can flip off of those, and then you get to see all my beautiful face, and you can look at that at the end. Anyway, so let me get started here. About our practice, Solomon Steiner Peck has been around for, I think we're in the 27th year, but mostly we practice in elder law, estate planning, probate, and business law. So I'm going to skip through some of these slides, which are a little bit more advertising for our firm, but you will see those when you get your copy. There's me. Oh, there you can now see what I look like, except I have glasses on today because during the pandemic, I'm trying to make it a little bit easier on my eyes and using my glasses because I'm on the computer a lot. So we're going to start out by talking about taxable and non-taxable income, because this is what we're talking about when there's impact for Social Security or impact for Medicare, and also for long-term care insurance premiums. We're talking about your taxable income for IRS purposes. So as you can see on that slide, wages, salaries, back pay, tips, interest, dividends, etc. Those are all things that most people would understand are actually taxable income. That's what you get reported on your W-2 forms. That's what you get reported on 1099s at the end of the, or at the beginning of the new year when it's time to do your income taxes. So most people get that, but there are other types of income that might be includable in your taxable income for income tax purposes to affect these different programs that people don't even realize or think about being income, like alimony. Like if you actually go to the casino and you win, you got to report those as you got to report your winnings as income. If you have debt forgiven because you can't pay a credit card bill or something like that, depending upon your solvency, that could be income taxable to you. Unemployment benefits meant to replace your wages are income taxable. If you hit the lottery, that's why a lot of people end up with a lot less money than they thought, because if you hit the lottery, you got to report that to on your income taxes or any kind of monetary awards. So remember that there might be income that you're not thinking about when we're talking about the various programs and what can affect what is affected by your taxable income. So things that aren't taxable income, workers' compensation, because you can't work anymore, is compensating you for an injury that happened on the job. Child support, typically, disability benefits, scholarships, federal tax refunds, capital gains on the sale of your house, up to a certain limit. Most people can, when you sell your home, there is still a $250,000 capital gain exclusion per person. So a couple can exclude up to $500,000 of sale of house. If you're single, it's only $250,000, but that's how they do the capital gains now. Way back when, it used to roll over into your new house, and at the final end, when you sold your last house, you'd pay some taxes. But now it just is a off the top amount. And then Social Security benefits, which is the first topic that we're going to talk about quickly. So if you have enough taxable income based on those lists that I provided earlier on in the slide presentation, A portion or most of your Social Security benefits can be income taxable. So if you're single, if you have taxable income of 25,000 to 34,000, if you're married, filing jointly with taxable income of 34,000 to 44,000, you have to pay taxes on 50% of your Social Security benefits. If you have lower income than that, then there is no income tax that you have to pay on any of your Social Security benefits. But, you know, with pension, with interest or dividends, it's not that hard to reach this level of income where you have to pay taxes on 50% of your Social Security benefits. If you're single and your taxable income is more than 34,000, or married filing jointly with income tax of taxable income more than 44,000, then you pay taxes on 85% of your Social Security benefits. So it's not that hard to get into the category, especially if you retire, but you've been saving for retirement. If you take out IRA distributions, that's income taxable. If you have dividends and interest from your investments, that's income taxable. So think about all those things that you already thought were income taxable, and even those things that you didn't know but are income taxable. It ends up being a pretty large percentage of folks do end up paying some income taxes on their Social Security benefits. Now, that's for 2020 still, and that's what we're going up. We're working up to the April filing for 2020 for income taxes. In 2021, the rules are kind of changing. We don't know quite where they're going to go. So we can maybe come back with another webinar once we see what's happening. Biden is talking about a lot of tax cuts, kind of undoing what President Trump did. So we don't know yet what that's going to look like. There's things he's proposed, but again, it's got to go through Congress and all of the agreement of both House and Senate. So we don't know yet what's going to actually play out there. So let's see. There's a question about discussing Roth IRA conversions and increasing tax bracket and Medicare payments. I'm going to talk about Medicare payments, how much Medicare costs, but we have another Tuesday talk that's going to focus more on IRAs and conversions and how IRAs impact things, and maybe converting to Roth IRAs as a way to reduce taxes. Speaking of Medicare benefits, Medicare in general. So I'm just going to do a real quick overview of the Medicare program in case any of you are here for parents or somebody else who aren't yet on Medicare. It's basically your health insurance that comes from the government. At age 65, you can be qualified for it. You have to find out if you're still working at age 65. There are a whole bunch of rules with regard to whether Medicare is primary or your employment insurance is primary, and you should, consult with somebody who has a great knowledge of Medicare to be able to sort that all out. Medicare in general. So there's 4 parts. Part A is hospitals, nursing home care following a hospital stay, some home skilled healthcare, and hospice. Hospice is covered under Medicare Part A. For those of you who didn't know it, that's why hospice care is to a great extent free. The medical insurance is Part B, that pays for doctors and other medical services. Medicare Advantage is kind of an alternative to traditional Medicare, and that they call Part C. So Medicare Advantage Part C combines Part A and B and Part D, which is the drug coverage, into kind of one overall overriding health insurance plan that is actually monitored and administered by a private health insurance company, not by the government like traditional Medicare is. So Part A, we already talked about that a little bit. For Part A, it's hospital insurance. Most people don't pay a premium because you paid into the Medicare program while you were working. But there are co-pays that have to be covered. And that's usually why you end up with a supplemental health insurance policy to cover those co-pays and deductibles, the 20% that Medicare doesn't cover. Medicare Part B is what we're talking about here for Medicare premiums. Usually the Medicare premium is taken out of your Social Security check. If you aren't drawing on Social Security yet, because you don't have to take Social Security at age 65, then you get a bill for it. So most beneficiaries have to pay. In 2020, it was $144.60. In 2021, it's $148.50 premium. That's at pretty much the lowest income level. We already briefly talked about C and supplemental, and D, you also have a premium for that separate, unless you have a Medicare C plan, which is just included. The issue is the Medicare B premium. So if you're traditional and that premium comes out of your Social Security check, it's paying for Medicare B. If you have a Medicare Advantage plan, for most people, that premium also pays for the Medicare C program, the Medicare Advantage program. And then you don't have to pay anything else, because in C, it includes A, B, and D with no additional supplemental health insurance you have to pay. But that's the premium, the one that's coming out of your Social Security check for most folks, that is based upon your income 2 years prior to the previous year. So, for example, the Medicare premium that was announced in December for 2021 is based on your taxable income. Remember that list from the beginning, your taxable income from 2019. So whatever your income was 2 years ago, which is the most recent filed tax return that IRS can base it off of, that's what they're looking at to see what your premium is going to be. The lowest premium in 2021 is that $148.50 that I say most folks pay, but it can increase to as much as over $500. So here's the table. This is showing your individual, if you file individually or if you file joint. If you're under $88,000 of taxable income, then that's when you're paying that least amount, the $148.50. And it goes up from there. If you're filing joint, you have $176,000 or less of income, you're still at the $148.50. But if you have, maybe you've got significant income from interest or dividends or pensions or other types of regular income that you get. It could also be, what if you sold some stock? You had some stock that was old, you sold it, it had a lot of capital gains tax to pay, and those are taxable. And 2 years, let's say in 2019, you sold a bunch of stock and you actually had capital gains earnings, not your regular stuff you get every month that you're living off of, but something else that caused your income to go up. Then what if you ended up with, if you're single over above $111,000 in income just because of the capital gain, then for the year of 2021, your Medicare premium will be $297 a month instead of the $148.50. So it can catch people by surprise because they don't realize, they wonder what happened. Why did my Medicare premium go up? Think about what happened in your life, or what you sold, or what extra income you may have had 2 years prior to the current year when they're telling you what it is. This happens a lot of times when we're working with a client trying to qualify for Medicaid, and they have to sell off assets because that's the only way to qualify for Medicaid. We need to liquidate things. We know that, and I warn people that 2 years from now, you're going to see an increase in your Medicare premium. The good thing is then the following year. So my example was in 2019, there was this big stock sale, which caused the Medicare premium to go up to $297. But in 2020, when they're looking at the 2022 Medicare premiums, your income is back down to normal and you're back down to $88,000 or less, your Medicare premium will drop back down to the $148.50. If you're wealthy and you have a lot of income coming in every year, then you maybe, if you're already on Medicare, you probably already know your premium is not what the base premium is. You might end up being substantially above that, depending upon what your income is. So always think about as a tax planning thing, what are you going to liquidate this year? Don't forget that, yes, you might have capital gains tax to pay, but 2 years from now, it could cause a major impact to your Medicare premium. And that if you're on a fixed income normally, that's a big deal if you're trying to have that come out of your Social Security check. Okay, income tax consequences from private long-term care. Let me see, there's a few questions that have popped up. All right, your slides show disability benefits as non-taxable. I'm not sure, it depends on the disability you're getting. It depends if it's coming from a company or from Social Security, or if it's SSI, which means you never actually worked, but you're disabled and you need some help from the government. So it may be or may not be. Okay, next question is it one bill for Medicare, or does each B, D, GAP plan send you a separate bill? Good question. So B is what I was talking about in that last portion, where it's the Medicare B premium that comes out of your Social Security check. It can also be the premium for a Part C plan if you have it, and that's the one bill you get for B or C if it's all rolled into one. If you have a Part D plan separate, which means you have traditional Medicare, you have A, which is premium free, you have B, that premium comes out of your Social Security check, and then you have D as your prescription plan, then you'll get a separate bill for that. If you have traditional Medicare A, B, D, like I just talked about, and then you have to buy a supplemental insurance to cover the 20% that Medicare doesn't cover, then you'll get a separate premium bill for that as well. The one that's affected by your income is the Medicare premium for B or C, that $148.50 traditionally, and for most folks, or more, that's coming out of your Social Security check. And is that premium per person? Typically, yes. So if it's a married couple, they'll each have a Medicare premium Part B or C, if it's the Advantage, coming out of their Social Security check. Now, there's all kinds of across the board. I can't tell you how many plans there are. There's a lot. And depending upon whether your Medicare is primary to your still employment insurance, if you're still working, or if it's secondary to your insurance, if you're working, there are differences in how everything is billed. If you are, if you have a Medicare Advantage plan that has extra bells and whistles, a few of those people are not only having to pay the Medicare premium that comes out of Social Security, that goes to help pay for it. Some folks have also an out-of-pocket premium for some of the Advantage plans. So what I'm giving you are general rules. That doesn't mean that your insurance or your plan or something might be slightly different, just because there's a whole lot of different options when you're choosing supplemental plans. There's a lot of options when you're choosing Advantage plans. And we recommend you see somebody who is well-versed in those choices for Medicare to determine what's best for you. Okay, let me see. If both spouses are over 65, do both people pay the Medicare premium at the projected income rates? So if you're married and filing jointly, it's the one chart that, whoops, I need to go backwards. Previous. Okay, so if you're married and you file jointly, then it is, yes, each person who is paying for a Medicare premium is going to be in the category wherever the income is there for you. Just like if you're filing single, you pay a premium. If you're filing married, you both pay a premium based upon what your income is. Hopefully that answered that question. All right, I don't see any others right now. So let me get to private long-term care insurance premiums. This is an important insurance if you get sick as you get older and potentially have to go into a nursing home. It's really paying for, it's nursing home insurance. There are a whole lot of different types of new planning right now. The original types of long-term care insurance were just that. They were just an insurance policy where you paid a premium and you got the right to an income stream if you needed long-term care. Most insurance plans like this cover in-home care, cover assisted living care, cover nursing home care. They usually pay out so much per day when you meet the requirements to draw on it, which are typically you cannot perform certain activities of daily living, like bathing, dressing, toileting, transferring, things like that. There's usually some trigger event. The younger you buy this type of policy, the less the premiums are going to be. Some of the problems are that a lot of insurance companies, when they first got into these long-term care insurance sales, they didn't realize that people are actually going to use them at some point. And they didn't charge enough in premiums to actually cover the amount that they're having to pay out for an individual. So a lot of companies went out of this business but kept policies that people still had already outstanding. Some of the older long-term care policies were pretty good, but a lot of those you can't necessarily get anymore. There are, whoops, let me go backwards again. So they have come out with some hybrid kind of policies where you buy an annuity, a single premium annuity, you put $100,000 away and it's going to grow. And if you need it for long-term care, you can tap into it. If you do not need it for long-term care, then you can name a beneficiary who will get the proceeds from that annuity later on when you die. There are also life insurance policies. And those life insurance policies are sort of a single premium life insurance policy. You put $100,000 into it, it's paid up automatically. Same idea, where you can tap into the life insurance policy to help pay for long-term care costs, like the nursing home or assisted living. And if you don't use it all up, there's still some cash value that can be paid to your beneficiaries. It evolved, the market sort of evolved into those types of policies because people didn't like the idea of having to pay. And if they didn't use it, they lost all the money that they paid in premiums. But it's kind of like car insurance or homeowners insurance. You got to pay. You got to have that insurance, because if your car is in an accident or you are injured in an accident or the house burns down, you need that insurance to make yourself whole. So that was the original premise, that why wouldn't you insure against your future potential for having to go into a facility? And this is not the same as disability, because you can buy disability insurance while you're still of working age, but that just pays out if you become disabled. This pays out if you end up in a nursing home, maybe not because of a disability, but because of an accident or some type of injury that isn't really making you disabled, but you still need to pay for the nursing home care, private pay, if you don't have any other way to pay it. Medicare will pay a little bit towards long-term care under certain circumstances, but not on an ongoing basis. So Medicare isn't an option. Medicaid can help pay for the nursing home on a long-term basis, but there's very complicated rules for qualification, and you have to get rid of a lot of your assets. So this industry became, well, those people who want to insure against this don't want to have to spend down all their assets and be broke to qualify for Medicaid, but Medicare isn't going to pay for it. That's where these policies came from. So they made them, hopefully they were trying to make them attractive to folks to buy these policies. I don't see a whole lot of people who have these long-term care policies. But certain ones, if issued correctly and with the right language in it, offer a tax deduction. So these are qualified policies issued on or after January 1st of 1997. They have to have an insurance inflation rider built into it so that every year it covers a little bit more based on inflation. It also has to measure eligibility by using those activities of daily living I mentioned before, or the fact that you are cognitively impaired. It won't allow a medical necessity trigger. Now, medical necessity is kind of how health insurance policies pay. If you go to the doctor and he orders some kind of treatment or whatever, if it's not medically necessary, insurance isn't going to pay for it. So these long-term care policies to offer this tax deduction have to have activities of daily living. You can't do certain things to keep you going every day, or you're cognitively impaired. They can't have a trigger that says, well, if it's not medically necessary, then we won't pay. Because that would knock out a lot of people who are in nursing homes, because medically there's nothing that can be done, but they still need to be there and they still need to pay privately, or they need to have help like Medicaid or like these long-term care insurance policies in order to pay. So here's the tax deduction part. If you've got the right kind of policy, as described on that previous slide, then there's a tax deduction that is allowed, but it's still tied to the medical expense deduction. You can only deduct unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. And I'm talking about the 2020 year. So again, it goes back to what is your income and what's countable and what's not accountable in your income. If you've got significant medical expenses, then you might be able to deduct part of the premium for the year. And it depends upon your age. So if you bought a policy young, which is, I think, partly the goal, that's why they start this attained age at 40 or less, you can get up to $430 tax deduction for the premiums that you have to pay for that long-term care. I guess they figure that the tax deduction will get you to buy one of these policies, and that will then cause you to use the policy to pay for long-term care and not go on the Medicaid program, which costs the government money. So as you can see, the older you get, the bigger amount of tax deduction you can get. When you get to be more than 70, it's a lot of money, $5,430. Now, these policies get very expensive the older you get. The closer you get to actually having to use them, then it definitely is more expensive. And a lot of the policies, people complain because it'll say your premiums are guaranteed not to rise. That is it's true and it's false. It is true in that they can't just raise your amount just because you happen to get sick. They can't raise your premium that you pay for this long-term care because you might be actually using it. They can, however, raise premiums for a class of people. So that would mean everybody who has policy XYZ from company ABC are going to get a raise in their premium. They can raise everybody's. They can't raise one individual that they think is going to be actually getting sick and using it. So it will go up. I've had some clients who have had to drop it because they could no longer afford the premium, and which is sad because, this is actually pretty helpful if you need to go into a facility. And that's why they offer these tax deductions. But there are less and less companies offering them because they actually have to pay out and they lose money sometimes. And there are other options now for people like these hybrid annuities and hybrid life insurance. The problem with those type of things, you have to have a big lump sum to put into it, to buy it, so that you can then now use your own money, basically, that you've set aside. And if you don't use it, it will go to a beneficiary, as opposed to just paying a premium per year to have the same kind of coverage. There is also something in the rules about a partnership plan. This is a little bit newer than this tax deduction for long-term care policies. So there is something, you have to have certain bells and whistles attached to the long-term care policy to be what's called a partnership plan. It's a partnership with Ohio Medicaid. Those bells and whistles include oh my gosh. So those policies are ones that have to have a premium increase based on a percentage increase in coverage based upon the cost of inflation for the year. There's a few other things. They have to be okayed by the IRS. But if they've got that coverage inflation protection of 5% or more, it depends on how old you are. It has to be higher the older you are, because you might actually use it. Then how that works. So let's say you've got a long-term care policy that's going to cover up to so much per day, up to $400,000 worth of coverage total. So that would be paying so much per day, $150 a day, $200 a day towards care, whether it's at home, assisted living, or nursing home. And it'll pay so many years that it'll pay out $400,000. The partnership part of it is, if you use that policy first and you use your $400,000 worth of long-term care insurance, then it's done. It can't pay anymore, but you can qualify for Medicaid and keep an extra $400,000 more than you would have been able to if you didn't have that partnership plan. So if you're single, all you can have is $2,000 to qualify for Medicaid. Instead, if you've used your $400,000 benefit from a long-term care policy, then when you go to apply for Medicaid, you get to keep $400,000 just off the top instead of only $2,000. So there is some benefit to having these, and as long as they qualify for a tax deduction, that helps you. And then if they qualify for the partnership plan, it can be useful. But I do understand that they get very expensive as the years go by, and some people just can't hang on to them. So I had a question about, how do we find somebody that can assist in finding a good long-term care policy? There are insurance agents who specialize in finding good long-term care policies that fit the person, rather than trying to fit the person to, this is the policy our company sells. So if you call the office or something, or let me know a way to get a hold of you, I can get you some names that we send people to. Again, we try to give people 3 or 4 names, because not everybody hits it off with every single person that they go to, whether it's a financial planner or an attorney or a long-term care person who is a specialist in that. So that was the extent of our Tuesday talk for today. I'm going to stop sharing so that now I'm back on the screen. Hopefully that was it was good information for you. If you want more information about any of this stuff, you can call the office. Any of us can talk to you. We're having additional webinars coming up the next 2 Tuesdays. Next week is Jennifer Peck talking about the IRA and Roth conversions and how that is, your income taxes are impacted by those kinds of things. And then Mike will be following up the following Tuesday and finishing up this little series on what to do now to help plan for 2021. Since we are past 2020, there's only a few things left, like making IRA contributions by the end of the year. I'm sorry, by the filing date for taxes, April 15th. But he's going to talk about what might be coming and what plans to start making for 2021. Any other questions that anybody has that, I'm confused about how a policy is a partnership with Ohio. Good question. It partners with Ohio Medicaid, because the partnership plan, if you spend, in my example, the whole $400,000 from your plan on the nursing home first, then for Ohio Medicaid, they allow you to keep $400,000 in assets instead of having to get rid of all your assets down to, if you're single, down to $2,000. So it's a partnership with Ohio Medicaid. Medicaid says, okay, you get the long-term care insurance, you pay that part of it, we'll cover it, and you get to keep that much in cash, so you didn't actually have to spend down all your cash or get rid of it. Okay, let me see. That looks like it was a chat. So somebody in the chat said, had an excellent experience with Lynn Beck, who is at the CAS company. And I know Kathy Herco, who owns the CAS company. She was a very good partner for choosing Medicare and which plan to take and which supplemental plan and which Advantage plan. So we do recommend the CAS company, KAZ. I'm not sure how I can get that information out to everybody, but if you go to your chat, it's there. And that might be helpful for anybody looking for choosing your Medicare plan. She is not the person to make the expert recommendation with regard to a long-term care policy. But yes, Kathy Herco and all of her folks that work under her are fantastic for making Medicare decisions. That's who I'm going to go to when it's time for me, and that's not so far off. So any other quick questions? Let's see. How do we get today's slides? We're going to be sending them to everybody who signed up for this by email. You're going to get slides. You're going to get an outline that's just typed up, and then you're going to get an evaluation form. Let's see. In 2015, Social Security said it was not worth my applying for Social Security from my divorced husband of 43 years due to the amount I received from my pension. Should I check on this? I suppose it doesn't hurt to always check on that. It might have been, the reason might have been that it was going to cause so much of your Social Security to be taxed. It would cost you so much in taxes, it wasn't worth the amount that you were going to get. I don't know. I don't know your situation. That's probably more of a tax professional, like a CPA or a financial planner question. Based upon your earnings and what they were looking at when it was time to make that choice. How does the filing extension work for the IRS since we might not even have our forms in time this year? Yeah. How much percentage for the extension? When does one have to file? I'm not sure what this year is going to look like. I know they started accepting tax returns February 15th. My daughter filed, so she could get her tax refund right away, and she can't wait for that money to come in. So I haven't heard about an extension at this point. I know that people are already filing, however. So you might want to go on IRS's website and see if there's anything posted. Is an extension automatic? Probably. Unless we're into the pandemic the way we were last year, I would guess that it's not necessarily going to be an automatic extension, but the IRS may do that, or Biden may order that. I don't know. I don't know yet. Ask that in 2 weeks when Mike is talking about what's going on in 2021. What happens with Ohio Medicaid if don't live in Ohio anymore? Kids are out of state, might want to be there. You lose Ohio Medicaid, of course, because you're not in Ohio, and you have to actually reapply for Medicaid in the state in which you are moving to. So it's kind of a hassle. But if it does make sense, if your kids are there, they can help you out. Under long-term care and qualify for in-home care as an unlicensed caregiver, is this taxable? Okay. I'm not sure what that means. If you pay anybody, so if you are providing care in someone's home for someone who is disabled or needs long-term care, and they're paying you cash or checks, technically that is taxable income to you because you're performing a service and you're getting something and you're getting paid for that service. I know there's a lot of people who don't report that, but it's supposed to be. And if you're on that end of it, you're getting paid for services. The person who's paying you is supposed to prepare a 1099 that shows you and what they paid you for that year, and then you're supposed to the person who's being given the care is to send that to the IRS so they know to look for that to be reported on your income tax return. If you are paying for care with somebody in your home and you're paying for the care, it's medical costs, so it can be tax deductible, which is why it's supposed to be income taxable on the end of the person who is receiving the money. I don't see anything in the chat window. Oh, that's too bad. You can Google, yes. That's how I find it if I don't have my list of numbers handy. Google the Kaz company, K-A-Z. They're in Independence, the main office. And Kathy Herco is the owner of the Kaz company, and she or any of her people will help you easily. Let's see, there was a question in chat. Why do some irrevocable trusts have both an EIN and the social security of the person who financed the trust? Does that person pay any taxes on interest income in the irrevocable trust each year? That's a little beyond my scope. Whoever sent that, if you want to call the office, we can get you an answer to that. I know the answer, but I just don't want to bore everybody else. And I want to keep this to a reasonable length of time too. Has somebody updated the book Golden Opportunities? No, not for a long time. I think the last update might have been in, a long time ago. Armand got too busy and now he's a politician. So he hasn't updated that. It will be way out of date if you look at it. It'll give you some basics, but the rules changed tremendously in 2016. So it's not, and it has not been updated since that point. So it's not going to help you. Usually have to file a particular form to get a tax extension. Right, you have to file for an extension and pay whatever, taxes and stuff. But I think with the pandemic, they gave everybody an automatic extension first to July and then to October last year. I don't know if they'll do that same kind of automatic extension because of pandemic. Okay, there's that same question again in the question and answer about the irrevocable trusts. Just to say any money earned by a trust taxes have to be paid on it somewhere, either in the trust or by the person who set up the trust. It depends. There's a bunch of complicated rules, and trust tax rates go up very fast. Personal tax rates go up much slower. So usually we try to have irrevocable trust income taxed to the person who set it up. And there's a way that can be done, but it's kind of beyond today. So somebody put down Kaz in Independence. If someone has Medicare and wants to get Medicaid to supplement it, what is the income limit? Most people, they look at all your income, Social Security income, pension income, disability income, all of those things to determine what your income is. There is something called an income cap. If the person trying to get Medicaid, if their gross income exceeds the income cap, they're technically not eligible for Medicaid, but they can qualify by setting up a special kind of trust. The income cap amount for 2021 is $2,382. So if your gross income, now remember, gross includes your Medicare premium, it includes any taxes that are coming out of your income towards the federal or state taxes, includes any deductions you have for health insurance in a company policy, let's say, for a company insurance out of your pension. The gross income is what they look at. And so many people do exceed this income cap of $2,382 when you consider it's the gross income. If you have income like that, you have to go through the steps of setting up what's called a qualifying income trust. Some nursing homes have it built into their accounting system that they can handle that qualifying income trust. Some don't. We set up a lot of qualifying income trusts for people, and you have to put the excess money into the qualifying income trust and then spend it from there. It's way more complicated. We need an hour. When I sit down with a client to talk about those, I need an hour. So let's see, it wasn't clear. Is the partnership with long-term care in Ohio, which allows you to keep dollars once long-term care is used, automatic? Yeah, there's nothing you have to claim or file. When you go to apply for Medicaid, you'll show that you had a long-term care policy that was a partnership plan and that you spent it all, and then you get to keep $400,000 of, in my example, you get to keep that $400,000 worth of assets instead of having to spend them down. Let's see. Also with extensions should still have to pay the taxes by April 15th. That's true. Although they did give an extension last year to July and then October, even to pay the taxes, because people were not able to get their mail. People weren't able to liquidate stuff. They couldn't get everything ready, couldn't get papers to their accountants and things like that. So it depends on how bad things get as we're going through this year. I think with the vaccines and everything, they're probably not going to do that same kind of an extension. That was a very unusual circumstance. The IRS wants their money and they want their money now. Let's see if there's anything else. Oh, somebody posted the CAS company telephone number. For those who can't see it in the chat, it's 216-901-9300. 216-901-9300. I'll have to tell Kathy I gave her a little boost on line in this. I'm not seeing too much else in the way of questions. So with that, and we went way past our half hour, but I appreciate the questions and I think they were very good and I wanted to try to answer them all. So those of you who are able to stick around for that, thank you. Otherwise, call our office with any questions you have about any of these topics I talked about. We can help you out. Watch next week's Tuesday talk with Jennifer Pack about IRAs and Roth IRAs and that kind of thing. And then the following Tuesday, I forget what the dates are. I think it's the first Tuesday in March that Mike Solomon will be speaking on what to plan for, how to look towards 2021 and what kind of things you should be doing. So with that, I appreciate your attention. Thank you all for being here. I don't see still, thank you. You're welcome. You're welcome. And thank you for the comment. CAS company does a great job and so do you, Laurie. Thank you. Thank you. I'll get you your money a little bit later. Okay. Thank you very much. So I will end now. And like I said, you'll get an email in the next few days with a copy of the PowerPoint, a copy of my outline, and an evaluation form. So, oh, pretty nail polish. Yeah, my granddaughter did my nail polish. Let me see. It's gold and silver and has little smiley faces on it. So I couldn't take it off after this past weekend. Chipping it off as we go. Thank you for that. Anyway, have a good day, everybody, and thanks very much. Bye-bye.